So should we buy or sell this real estate ETF? So first off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. We are going to look at the IYR, the US real estate ETF. It is 21% from the 52-week low and 19-ish% away from the highs. Here are the weekly data points, and we can go pretty far back. What I find especially interesting is that we have a pretty key signal. So let me draw it in. So back in the day, the red 200-week moving average has been very viable, even for a temporary bounce. But something we can also see is that this same moving average is pretty important here for the bears. We can add some selling pressure. Cluster back here, and recently, right now, we are testing it as a resistance level. So we are currently below a very important level. So it's like the key indicator. Another thing here is that this green 50-week moving average is about to cross below the red 200-week moving average, which is a weekly death cross, which potentially can be very bad. It's a very slow moving indicator on the weeklies, but not good. On the dailies, we do see a little bit of a peak above the 200 daily moving average. So there's some strength here on the dailies. The problem, though, for the bulls is that we have had some times in the past where peaking above is not really sufficient. And even here, you do have a bit of a cluster of, success above that level, but it's all about staying above. Yes, but there are some mixed signals. When we look here at RSI, PPO, and the rest, we do see that we are at the previous fail level on weekly RSI during this rally back here in August of last year. But generally speaking, we do not have extreme readings here on the weeklies. On the dailies, then we are in more treacherous territory. This is a high level on RSI that we occasionally get a bit above, but not much. So on the dailies, it's getting a bit more spooky. In this case, I will give the bears a -6 here. On technicals, the key entry signal is 200 weekly moving average resistance. Let's have a bit of a look here at the seasonality. Here are the let's start here to the left. So we do have the seasonal forecaster. Green is the average over the last 5 years, 7 years in blue, 10 years in red. So usually the period from late December into late January is a weak period for this real estate sector. In this time around, the seasonality has been flipped, but we are sort of due that weakness. When we look here to the right and look at January, we currently are at the 9% gain, which is one of the highest gains we have had. In 2019, we had 11%, and then February was mediocre. Very strong in 2012, 6.44%, then a weak February. 2007, strong January, weak February and March. 7% here in 2006, but then there was continued strength. But we definitively have seen a very strong January, so maybe the expectations for February could be that the bears will look for opportunities, and the bulls will likely look for some profit taking. So I think one could make the case here that both bears and bulls are likely to add some selling pressure. I will give a -4 here, but overall I do think that there's reason to be a bit bearish. I am now comparing US real estate against the global REITs. Looking at performance over the last year, we do see that US real estate is slightly outperforming global REITs. Price earnings is 50 versus 31, which is substantially more overvalued, climbing towards the double, so that's not bullish. Annual yield is 1.7%, which is not really that good for a REIT ETF. It's 2.15% for the global REITs, which is better, but not really spectacular yield here. Here you have the components. The categorization here is a bit strange, but yeah, some would say it's finance. Well, this is why the sector debate when it comes to ETF is very messy. Okay, so market cap, large caps, more diversification here in the REIT ETF. USA is dominating both, and that makes the massive difference in price earnings even more spectacular. So in this case, looking at the fundamentals, I would say that this one is pretty richly valued. So -5 here to the bears. So we start here with weekly data points, looking at relative performance. Against the S&P 500, we have 91% positive correlation, 98% with REIT, which is very strong, 18% with the 10-year yield. Looking at the daily data points, 98% with REIT, 81% with SPY, 90% negative with the 10-year yield. But obviously, looking here, longer term and short term, the strongest correlation is with REIT. Here we have that one. And in this case, we have had a strong rally as well. RSI is seeing some kind of a breakout here, which is a bit constructive on the weeklies. The green 50-week moving average could become an issue. On the daily data points, we have a strong breakout above the 200 daily moving average, but looking at the RSI, MACD, and the PPOs, we are very, very high. So yeah, the risk of a pullback is substantial. Yeah, looking at seasonality also, we have this flip of the seasonality, which means that we are very much due the weakness. And when you haven't had that weakness, and there usually is, it gets a bit risky. Let's compare them against each other. So in this case, US real estate has recently underperformed the globals. It might be some time cycles here. There are actually some relatively reliable time cycles, but especially recently they have shown that clear reliability. It suggests that there could be more weakness from US real estate into underperformance into late February, and then a new rising phase might begin. Looking at the dailies, yeah. We see that during some previous rallies, we've seen this retracement, but not complete retracement of the preceding rally. So yeah, the declining part of the time cycle might be coming towards its completion. Looking at the seasonality here, the seasonality is very messy. There's been this disturbance in the force, so to speak, but there is some weakness expected into early February. But then US real estate usually outperforms the globals. In this case, on relative performance, I will give the bulls a 5. The biggest strength here is that the US real estate ETF, it does have a strong, recently at least, seasonality versus the REIT ETF. So it could have some outperformance on the horizon. But that doesn't mean that both are going to go up. It could mean that the US real estate ETF will go down less than the globals and seemingly then outperform, which is would, but it wouldn't really be outperforming against alternatives. Okay, but yeah, we do end up with -2.5 to the bears. The 200 weekly moving average resistance is the key signal. So we do have some time left. Let's look at the main components of the US real estate ETF. Here is Prologis. Well, Well, it is interacting with the blue 100-week moving average, but looking back, we don't have that much clean interaction. There's some interaction, but not a high level of it. On the dailies, we do have a bit of a breakout in progress, but here again, we are so close to really getting into dangerous territory on RSI. Seasonality also have that flipped situation. 14.5% so far for January, which is way outside of the average. Yeah, so there's not that much reason to expect a whole lot more left here. Let's look a bit at valuations. So here we have the price book ratio in blue, price to sales, price earnings. Well, the valuation isn't historically that atrocious versus the more recent history of the stock. 2.43% yield. What is the forecast? So the average upside price target is 5.6% above us. So there is some upside potentially. But could be a bit more left, but a lot of the move has occurred. At least the easy part of the move. American Tower Corporation, AMT. This one is a bit weaker here on the technicals. A bit messy on the technicals as well. On the dailies, the green 50-day moving average was a very good level. You can see here, very reliable. But recently we lost it. We are peaking above it, but we have a sort of like a broken support level, which is not really ideal. So let's go to Equinix. On Equinix, we do have an inverse head and shoulders pattern in development, which is bullish. Ideally, you want to get in near the head or one of the shoulders. Well, the right shoulder, because you don't want to be part of the head forming. Unless you get in near the bottom of the head. But in this case, we have seen a strong rally. Are we overbought? Let's see. No, not yet on the weeklies. On the dailies, we are using the 200 daily moving average as a support, which is constructive, a bit elevated on RSI, PPO. Seasonality here, we do have that flipped seasonality here as well, 11% so far for January, which is one of the better Januaries. You do see, however, that during previous years, this one has had some very strong Januaries. So that's potentially a bit interesting. Valuation on the price earnings isn't historically that bad. Let's look here at the price targets among the analysts. Forecasts. So 23 analysts have a 1-year price target. The average is 3.6% above us. So it ties into the general message is that there could be a bit more upside for some of these in the real estate stocks, but the easy move has happened. If you get bullish now, you have then missed out on a 48% move, bullish move, and so the easy move has been made. To get 48% from this level, just to have that breakout above here would simply be a 21% upside. And that's far above what the analyst price targets are. So let's quickly have a bit of a look at the S&P 500. We do have a breakout above the green 50-week moving average. On the dailies, breakout above the 200 daily moving average. So some constructive action, not really dangerous on RSI or the PPOs. Seasonality is flipped here as well. 6% so far for January, which is it is the second best January since 2019. So sure, we could have more left here in the real estate sector, but generally speaking, we do have some very elevated readings on the technicals, very hot, very overbought. The seasonality data and the fundamentals also show that this is very stretched. So it currently has momentum. but the easy bullish moves have been made, so I do think that it's getting more and more appealing for the bears.